about stocks. And this is for mostly beginners who's beginning to get into the market, the stock market, and you're kind of wondering, you know, what are some things you should be watching out for when you start investing into the market. As you can see at the moment, the markets in December 2018, they're crashing. We're down almost 20% from market highs. We're at a 52-week low, and before you jump in, um, these are some things that you should definitely be looking out for when you do invest. And yeah, so we'll go through few of the top 10 things you should be looking out for when you begin investing into stocks. So, let me see here. Um, doesn't seem like I can. Okay, there we go. Let's see. Number one is buy low and sell high. So remember, guys, you always want to buy at the lowest price when the stock has maybe declined um 10%. That's usually where the bear market average is. So you kind of want to be looking for a dip in a good solid company, maybe like Amazon, you know, Facebook, Netflix, etc. I don't know, whatever, you know, typically a big size company that's more stable and has a long term, future into the stocks. So obviously buying low and selling high sounds simple, but you never know when the prices for a particular stock is necessarily low or not. You're going to have to kind of look at the financials, the overall, balance sheets, and where they've been priced, previously in the years, you know, maybe past 5 years, where are they trending? Is it a growth company or is it likely to fall even further or go out of business? So those are some factors you do need to take into consideration when you go into investing stocks. Number two, there is no such thing as a sure thing. Even when, you know, a, a particular stock may, you know, maybe down, let's say like 90%, you're going to think, oh, yeah, this stock definitely will bounce back up at least maybe 60% of that to, even out the loss, but that's not exactly how markets work. And, anything can definitely happen, and you should be definitely considering, any potential loss into the markets. ESPN is immune to the shifting sands of the cable business and be able to mint money for Disney will never be in doubt. Alibaba is a world beating juggernaut that can't be stopped. So, I mean, few companies definitely, it's very unlikely, but the potential's still there to lose a lot. The conventional wisdom isn't always wrong, but it frequently has terrible timing. Some of the stock market's best investor over the long term, Warren Buffett, Carl Icahn, and their ilk have placed their biggest bets on companies out of favor or during times of market stress. So I guess bigger investors tend to look for bigger investors look for um, lower or smaller companies, and they kind of bet on them more than the alternative bigger ones. Um, Number three is get familiar with the filings. Some investors might think that they have a sixth sense for finding good companies, but there's no better starting point than regular filing. Public companies make with the SEC, which are required to detail everything from the company finances to potential conflicts and risk factors. The annual 10K includes the most information, ranging from quarterly and annual financial numbers to description and business lines management, and a commentary on growth opportunities and costs. Regulatory filings will also detail any senior management changes, acquisitions, and stock transactions by executives or board members. So, as we can see here, um, the best way, the most surest way to know or to figure out if a um, company will is in a good spot and will continue to grow is to look through their filings with the SEC, which includes the annual 10K, and this includes the most information from their financial numbers and the business lines management and the regulatory filings. So essentially, just look through the 10K, 10K, the most important document that you will need to look at for any potential investments. Another thing is think long term. Taxes are only reason short term trading is a loser's game for most investors. Trying to buy or sell shares based on quarterly earnings reports or an economic data point is a game for automated trading platforms, not the average Joe. Better opportunities come when a stock or sector is dismissed by the market and languishes despite steady economic results that will that will produce a long stream of profits. Transportation stocks like airlines and railroads have gone through long out favored stretches only to churn out at considerable where were we? Considerable rates, your years of mismanagement, the airlines, okay, gone through. So just think long term. Markets will tend to bounce back usually. Dividends are your friends. Share price dropped. Apple's dropped from 110 to 105 in 2015, but people still own the stock because they paid out $2 in dividends over the course of the year. And ultimately, dividend paying stocks can supplement the losses you do take in any given stock. Um, Shark Tank investor Kevin O'Leary is fond of statistic that shows the bulk of S&P's 500 return over the years came from the dividend and not the price appreciation. So, yeah, that's also a thing to take into consideration. Number six, there is no perfect metric. Even professionals and people who have been doing this for years and years can predict a certain market movement, but it doesn't always go the way they would like to hope it to go. $100 stock isn't expensive, and the $5 stock isn't cheap. While triple digit price tags may cost too much, loading up on $101 isn't necessarily a better strategy. Think of investing like grocery shopping. There's a reason you go to the store with a list instead of just deciding what to buy based on price tags. Taxes can take a bite out of your profits. Facebook, Amazon, Google had a great run, returns from 34% to 134%, but a tax prospect who bought last year and eyeing exits want them to keep climbing. That's because 1 year mark is a line of demarcation for the tax man. Selling stocks you've held for less than a year triggers a short-term capital gain tax as ordinary income that could mean kicking back anywhere from 25 to 40%. But if you hold it for 12 years, the tax rate drops to 15% for most tax brackets. Um, know what you need and know what you're paying for. The evolving brokerage industry is a beehive of competition to offer the latest and greatest trading options, but for most investors, the basic essentials can be found anywhere. Make sure you know the type of buy or sell you're ordering. A market order, for instance, will be executed as soon as possible. Limits. Okay, so basically, when you buy a stock, make sure, or you want to set an order at a specific price range um, to buy, right? So you know you're buying it at that price instead of whatever price it is when you do buy it, so it doesn't create any variations, and um, you save more essentially, or potentially save more, and it's just more consistent overall. And the final point is take the market news with the whole shaker of salt. So basically, like the headlines from the CNN and all these other news companies, um, you know, whatever they say or whatever they predict, it's not always true. And use your own logic and reasoning and develop your own strategy when you go into investing, because it is ultimately your money and it's going to be your money that you're going to be risking at the end of the day. So it should be ultimately up to you. As we can see by point 6 here, no one's perfect and no one knows perfectly what's going to happen. We can only give our best opinions and thoughts on any given stock and hope for